Hey everybody, Brian Lee here with AHA Real Estate Exam Prep, helping students get through the state exam, taking little digestible pieces, working through small little pieces, just the small little nuances, little things that will help you to get through the state exam. We know that the state exam is that monkey on your back, the thing that you want to get knocked out. Again, just today I was on a Facebook Messenger board, and somebody has taken the exam or had taken the exam. I'm not sure what part of the country they were from, but they'd taken the exam like 12 times. And that was just some tenacity there. I mean, again, failing 11 times just beat this person down, but they jumped into it. They put their big boy, big girl pants on, whatever you want to call it there, and knocked it out the 12th time. So again, just keep with it, guys. I know the test it sucks. I know. And I will tell you that the real estate industry is even tougher. But at least once you're in it, once you get through the state exam, it's worth it. It's just, the exam is just one more thing. So stick with it, stay positive. You'll get through it just like the person did today. Knocked it out the 12th time. They're so excited. I'm so excited for them that they got it done. So today in this episode, we're talking about capital gains and just some various things that we get into as far as investment property and even property in general, as far as holding of real estate. There won't be, I should say, a great deal on the state exam on this topic. Just a few things. I want to make sure you know a couple of the terms. I have yet to see any part of this calculation as far as the math. So I don't go through the mathematics of capital gain. But if anybody sees that, please let me know, because I will go through it. I'm just not going to go through it tonight because, again, it's more than what we need to get into. And honestly, even in the real world, agents don't do this. I would be more worried about the process behind it than I would be how to calculate it. We have accountants, or rather our clients, the buyers and sellers that we work with. They have accountants, they have tax professionals that will guide them, that will do this actual calculation for them. So the expectation is not for us to do it, just understand some of the pieces of it. So that's what I wanted to get into here. So a couple of things to be aware of. A capital gain is the amount of money that the IRS will look to tax. In a very generic way, and I'll drive into this a little bit more, but in a very generic way, the capital gain is going to be the difference between what you paid for the property and how much you sold the property for. So just starting off with that basic, let's say you bought the home 5 years ago for $150,000, and after 5 years, you've done some things to it. You built a deck, you added on to remodeled the kitchen, something like that, and you sell the home for $200,000. So in that generic representation, you bought it for $150,000, you sold it for $200,000. So your gain would have been $50,000. That's the general concept. It's not that the $200,000 is not a gain. We're going to subtract what you paid for it minus what you sold it for. And so in this case, that's $50,000. Couple things to be aware of, though, because as we dive into this a little bit more, there's other things that we would pay attention to as well. For example, the first thing we want to make sure that we know is that a capital gain is classified in one of two ways. It's either a short-term capital gain or a long-term capital gain. A short-term capital gain is when you hold the property for less than 12 months. So basically we're saying is that you buy it in March, let's say, and you sell it before March of next year. So you've only held the property for 10, 11 months. You did not hold it for at least 1 year. In that case, it's called a short-term capital gain, and you're taxed at your normal tax rate, whatever that would be. So for everybody, it's going to be a little bit different. The second type of capital gain that you'll have is called a long-term capital gain, and that is for a property you hold for 12 months or longer. So again, bought the same property. I bought it in March, but I sell it in April, May, June of the next year, or even years out from that standpoint. That is called a long-term capital gain. So that's what we're looking at there. Couple of things that we pay attention to as far as terminology is that when the capital gain is being calculated, we don't talk about the original cost of the property. What we talk about is what's called the basis. That is the original cost. So if you see the term basis on your state exam, What they're saying is that what was your original purchase price? What did you buy it for? So my previous example, I said they bought the home for $150,000. That is that homeowner's basis. That's how long that is what is where the calculation begins from, is that we say that your basis was $150,000. From there, then we look to see, okay, what did you sell it for? But before we talk about the $200,000, we need to say that you've done some things to this property, and some of those things might be what's called a capital improvement. So if you see that term, a capital improvement is going to be something that you've done to the property that makes it worth more. So I mentioned a remodeled kitchen. That's likely going to make the property worth more. So we would calculate, or that would be a factor into our basis, or rather what we're working toward is the adjusted basis. There might be other things. And again, the test is not going to dive into what this is, but just to say they'll probably, if they mention anything, they'll say that you've done capital improvements of $10,000 or something like that. So it's not even qualifying what it is, because there are some repairs or some things that you do to a home that don't add value. So it's not that you're adding everything that you've done to the home, but certainly in the case of that kitchen remodel, we're probably going to include it. The next thing we're going to look at then is to say, okay, you sold the home for $200,000, but before we work through the calculation on that side, we're going to recognize that you had some expenses to sell that home, that likely you paid real estate commissions, that there were closing fees. So even though you sold it for $200,000, let's say that you had $15,000 of closing fees and cost and realtor fees and things like that. So really your net sale price was only $185,000. So there's a calculation that we worked through in there. And really what we're getting to here is by recognizing the basis, we recognize the purchase or the sale price, we deduct the selling expenses, add in some of the capital improvements, and we're working toward here in the middle, ultimately, is what's called the adjusted basis. That's what that is. So in the capital gains calculation, that's what we're looking at. Again, I took a little bit deeper of a dive than you needed to probably know, but I just wanted to put the pieces together for you so you understood the terms basis and net sale price. And the adjusted basis is that middle number where we take the basis, we take the sale price of $200,000, and somewhere in the middle will be our capital gain, not that entire $50,000. Couple of other things, and I will do a deeper dive on this in the next segment, talking about tax deductions and all that, is that there are some ways to avoid capital gains taxes. We'll talk about home ownership and all that, so I want to make sure we get into that in the next episode. But one of the things I do want to address here that ties directly into the conversation of capital gains is something called an exchange. And you might see it a lot of different ways on the state exam. You might see it represented as a 1031 exchange. You might see it represented as a Starker exchange. So usually, I mean, and it doesn't matter whether it's a 1031 Starker or whatever. If you see the word exchange, and they're talking about it in this concept of capital gain, what they're saying here is that this exchange offers the property owner, the seller of the property, the opportunity to defer the tax. And that's the big piece that I really want you to hear me say in this, is that a tax exchange or capital gain exchange, 1031 exchange, Starker exchange, regardless, if it's an exchange, what you're looking at doing is deferring, meaning that you're putting off the tax. It's not that you're eliminating the tax. 1031 exchanges are not a tax elimination. It is a tax deferral that you're putting it off to some point in the future. So that's what an exchange does. So that's an opportunity that some people might have to avoid paying the capital gains tax right now. You may still have to pay it in the future, but you don't have to pay it right now. So I wanted to address that real quickly. So let's go through a couple questions to see if we see where you're at and make sure that we're on the right pages. So the first question we get into is, what is the difference between a short-term and a long-term capital gain? What do you think? Be careful here with this one. Be careful here because there's one of the answers that I threw out there that throws people off. So the difference, is it the amount of income produced? B, is it the calculation needed to determine the basis of an investment? Is it C, simply just 1 year? Or D, is it the difference between a larger and a smaller potential tax rate? What do you think? What do you think the difference between a long-term and a short-term capital gain would be. Go ahead and throw out A for you, because the amount of income does not matter. The IRS does not matter. I mean, they don't say they don't care what income you make, but whether it's $1 or whether it's $100,000, they're going to get their tax. They're going to get their claws into it. So A is definitely not right. B, I'm going to throw that one out too. The calculation needed to determine the basis. The calculation is the same. That does not change. We calculate the capital gains the same way from there. Darla, that's you're doing the same thing that Greg did the other night. It's like, it's one of these two. Try that on the state exam, see how that works. So the answer, looking at C, 1 year. But what was the difference? What was a short-term gain? Short-term gain is something that happens within 1 year. A long-term capital gain is one that takes a year or more. Work through that in your head for a minute, though, because I see a lot of you picking C, and C is not the answer. Think about it from this standpoint. If I held the property for 364 days, I'm under a short-term capital gain. What if I held out for that extra day? I went to 365 days. That does not make 1 year. 1 day made the difference on that. So the difference in that specific example that I just gave you was 1 day. 1 year is not the difference here, guys. I know that 1 year is the cutoff between short-term and long-term, but literally it could be a 1 day difference if you held that property for 364 days instead of 365. So the answer is not C. The answer is D. It's the difference between a larger and a smaller potential tax rate. That the short-term capital gain will typically have the higher tax rate. Not always, but usually it will. And the long-term capital gain will usually have the smaller potential tax rate. So the answer is D on that situation. All right, next question. D for dang it. Susan and Joe, a married couple, bought a principal residence in 1991 for $200,000. They sold the property in 1999 with a capital gain of $150,000. Capital gains tax on their profit will be. We've not talked about this yet, guys. I'm not sure. These slides are out of order a little bit here. Apologize for that. We're definitely going to talk about that in one of the next episodes. But just for the sake of the case that all of you should have taken a class, and hopefully you know the answer to this, but we will get more into this in another class. But they held the property for what? It looks like they had it for 8 years. They bought it for $200,000. They had a capital gain of $150,000. They made some bank on this. Sold it for around $350,000. Nice. Capital gains tax on the profit's going to be what? Is it going to be the $150,000? Is it going to be $200,000? I don't think it's $200,000. Is it $50,000? I'm not sure where that number came from. Or is it $0? The answer's A. You got it, Darla. It's 0. We haven't talked about this yet. Again, I'll get into this a lot more depth, but because they held the property as their primary residence for at least 2 out of the last 5 years, they don't have to pay anything on that because they're a married couple and it was less than $500,000 was the gain. So we'll get more into that, but the answer is A, $0. Next question. One method a real estate investor may use to defer. It's always a funny word. When I say it out loud, defer, like it has fur on it. We're going to defer defer capital gains tax is to what? Sell the property for cash only? Gosh, that would be awesome. I would love to be able to sell property for cash only and not have to pay tax on it. I'm sure some tax cheat out there's figured it out. I would never do that. I would not do that. So if any IRS agent is listening, I always pay tax on my properties, even if I sell them for cash. B, obtain the maximum amount of leverage. Well, leverage is borrowing money. That has nothing to do with deferring capital gains, which that's actually something else that's interesting. The amount of your mortgage does not change your capital gain either. If you owe $0 on mortgage or you owe 100% of mortgage on the property, that does not change your capital gain. Mortgage does not change the capital gain at all. C, exchange property for like kind. I'm seeing a lot of you picking that one. I think you're on the right track there. Or D, build a reserve account for items that are likely to wear out. That is good from an investment standpoint, but has nothing to do with capital gains. You are all correct. We're going to exchange that property. We're going to put it through that system and defer the capital gain tax. All right, next question. When calculating a capital gain in a property, an investor would use the original cost of the property. That original cost is known as what? Is it the adjusted basis? Is that what it is, where we adjust out, we factor in the sale price minus the cost of selling the property, adding in all the capital improvements and all that? Is it the basis? Might be that net sale price, I guess. I don't think so. Sale price after depreciation. Depreciation does play out in capital gains, so maybe that's the answer. But I'm seeing you, several of you picking B, and I believe that you are correct. The answer is basis. That's exactly right. The original cost of the property is going to be the basis. All right. So again, not a deep dive on this at all. Just a couple of pieces that you'll need to know about not the next webinar, but the webinar after that. I think we have scheduled out. We'll talk more about tax deductions. I'll dive more into what that capital gains question was, how that family, how that married couple, how they avoided paying any tax. So for those of you that didn't follow along with that, that's fine. We're going to talk about that here in just a little bit. So we'll knock that out. But at the end of the day, just make sure that you have the basic idea of what we got into tonight. The short-term gains versus long-term gains, exchanges, things like that. So hopefully that helps you. If I can do anything for you, please reach out to me at Brian C. I'm sorry. That was my podcast. Sorry. I'm still in that mode, guys. Problem, I wear too many hats. The hat tonight is AHA. Hi. So reach out to me, Brian, at AHA, REEP.com. Thanks, guys, for listening. Take care and have a legendary day.